Cool. So we are now on to video number 3 of this series, where today we're going to be talking about market cycles, market breadth, and trading conditions. This is going to be a pretty convoluted video, and I'm going to be throwing a lot at you, but I think it's important to maybe rewatch this video a couple times and really soak in all of this info, because this is basically the foundation that is going to lay the how you're going to trade and the process for which you're going to trade, because it's going to provide the context for everything. So we'll jump right in. What fuels stock movement? It's going to be news. So news is what is going to fuel stock movement most significantly. So whether that is company news, earnings, or economic news, that is what's going to depict a stock's performance or a stock's trend the most. So whether that is company news, like a new product, a new direction, or a new CEO, that can massively sway the trust of investors and thus price. And then earnings is always going to be a key point in how analysts and investors develop the perceived value of a company, and it has quite possibly the largest impact on a stock's price and performance. And then economic news can present new challenges or strengths for specific groups of stocks depending on the data. And then it can also harshly impact the market health or really positively impact the market health as a whole, like we saw with full-scale market corrections like Trump's tariff announcement. So this is the chart of SPY. This is the S&P 500 on the daily chart. And you can see we're in where we basically are always moving up for the most part. But we have these big moves up, and then a pullback, and then a move up, and then a pullback, and a move up, and then a pullback, and a move up. And this is how SPY is going to trend all the time, and it'll probably trend like this until everybody who's watching this video dies. This is exactly how assets like this trade. As more people put more money into it, the general trend of this is always going to be up. That's why it's a safe investment. But as far as swing trading goes, there are going to be optimal conditions to where your trading is going to be the most successful. When you're looking in these red zones where we're in a sort of a short term or an intermediate term downtrend, it's going to be really hard for stocks to pop up out of bases when the general market is sort of trading downward or sideways. So what you really want to be looking for is, when you're trading breakouts, you want to be in the midst of this very like steep uptrend. This is going to be the most optimal place to really seek for these breakouts. So I'm going to introduce the concept of market pressure. When I refer to the market as a whole, I'm going to be using the S&P 500. It's just the most applicable index for this. I trade almost exclusively U.S. stocks, and so when I refer to the market as a whole, I'm really going to be using the S&P 500 as a benchmark for that. But the S&P 500 can be referred to almost like a weight on stocks. So that's where the term market pressure comes from. And I'm going to introduce market breadth here, but as far as what fuels sort of upside moves and downside moves, a positive asset change like good earnings or good press release, and then as well as a good market headwind, or where we're in that steep uptrend, that is really going to fuel upside moves for strong stocks. And then the inverse is true, where a negative asset change like really bad earnings or a really bad press release, and then and or a market tailwind can really ignite fire under a stock to really just shit the bed and plummet. As far as market pressure goes, what you're really looking for is, if we're in the context of a really big downtrend or a intermediate term downtrend, you're going to have a lot more weight on individual stocks, and it's going to be really hard for them to power out of bases and continuation setups when there's so much weight being held down on that stock. And then vice versa, when we are in a steeper uptrend, there is a lot less weight on individual stocks, and stocks are really able to float up and pop through these levels of resistance and move very quickly to the upside, because there's not very much holding them back. And so the way that we see this the most effectively is going to be through market breadth. On the top chart here, we have SPY on the weekly chart, and then down here is this ticker that is S5TW. This is going to be the percentage of stocks that are above their 20-day moving average. So what we're looking at is that you are going to have these two zones in a sense, and anything that's highlighted in red is going to be 75% or higher. And then anything in green is going to be 25% or lower. And so the reason that they're colored like this is that when you're down here in this 25%, this is where you're going to be looking for an upside move. So when we are up in here where almost 75 or more percent of stocks in the S&P 500 are above their 20-day moving average, that means that almost everything in that basket is moving very positively, and it might be overextended. So when we're up in this oversold area, we're looking for these sharp moves to the downside that create these pullbacks on the SPY chart so that we can be aware of when trading is going to be favorable and when it's not going to be favorable. So I'm going to highlight some areas on here, and they're going to be top and bottom. These are for the exact same date range. But so this will start to make a little bit more sense. But so in red, when we've entered into this oversold area, and then we flush really quickly down to we're in this overbought area, and we flush really quickly down to this oversold area, we're looking for a very quick move to the upside, because what we've created is this steep pullback. And when we see this first like candle in here, we can sort of assume that there's going to be a full rebound or a move all the way back up to the top. So that's what you see here in this green area. And then anytime that we sort of float in between this area or this like spread in here, it's going to be looking towards, it's going to be more like general bullishness. So you're going to see these tiny little pullbacks in weeks and days in here. But as a general rule of thumb, we are trading upward because SPY has a general upward trend. So when we just sort of float around in these gray zones, it's going to be just general bullishness with some pullbacks, but it's going to be that's still very favorable. That's sort of what we want to see. This is the weekly chart, and I'll move us down to the daily chart, and it'll start to get a little bit more freaky looking, but it'll make a little bit more sense maybe. So this is the daily chart. This is the same time frame, and I'm going to use the exact same highlighted zones as I had for the weekly chart. So you can see that we are up in the oversold, or we're up in this overbought area, and then we're going to flush really quickly down to the downside of here. And this is where we get these steep pullbacks in here. And why it's highlighted in red is you do not want to be trading breakout setups during this. This is going to be very unfavorable for the trading strategy that I use. And for any swing trading or position holding strategy, this is going to be incredibly unfavorable. And then vice versa, the upside of this, when we're sitting in this oversold area, we're looking for that move to the upside. So when we start to see this quick pop up, you can sort of assume that this is actually going to be the most favorable time to trade. And then anything in gray is going to be is still favorable, but it's not as favorable as if we were coming up from this big pullback where we have a lot of upward thrust in a sense. This is going to be the strongest area to trade breakout setups, just because SPY is pulling up so quickly. It can almost be referred to as a basketball that's being held underwater. So when we move down into this downside and the market tide sort of comes in, we're holding a basketball underwater in a sense, and then when we let it go, it's going to have a lot of upward thrust back to the upside. And so you want to be in stocks and trading breakout setups during this, as well as the times when we just sort of trend sideways and we have general bullishness. But obviously you're trying to avoid areas in the red zones where we're just trading straight down, and then you're trying to be in stocks here and mainly holding, and then we're really getting aggressive in these areas where that basketball is being let go and thrusting its way up. So market breadth is just used to understand the context of the market from a bird's eye perspective. The percentage of the stocks for 20-day moving average is into overbought and oversold, when we can expect the pullback to sort of be reverting back to the mean of the market. So the market as a whole doesn't really like super big extremes on either side, and that's just because of the relationship from buyers and sellers that we talked about last time, where we can't have it be too pushed in either direction, because you're going to have that snap back almost like a rubber band. So anything overbought is overbought is going to be anything above 75%, oversold is anything under 25, and then hovering between 75 and 50. So this like upper edge here is going to be very bullish, and then anything below is bearish or just sort of neutral in a sense. And then these are the tickers for this. So I use the 20-day moving average for this. I think that it's the most it updates the fastest for me. It's easily I think it's the quickest one to see. But so S5TW is the 20-day moving average, S5 or FI is the 50-day moving average, and then S5TH is the 200-day moving average. And I would highly suggest that you explore these. You can pull these up on TradingView, and you're not going to have the colors or anything like this on here. You'll have to add them yourself. But I think that watching for the correlation is very interesting, and it can be very helpful because if we were up in this range like we are now, and SPY is starting to look very extended, I think that the next strong move is going to be to the downside because we are so up in here. But when you don't have this as a context, it's a little bit harder to read SPY and say for certain that you think that it's going to come down. So I think that that's why this is incredibly valuable. And then, so now that we've talked about market breadth, and that is going to be how indexes in the market as a whole trades and just sort of the movement of that. I'll introduce you to Richard D. Wykoff. He's a trader from about 100 years ago, but this dude was a genius. He came up with the Wykoff method and the Wykoff price cycle, and this is something that day traders, swing traders, investing value traders use. This is sort of a unanimously agreed upon concept in a sense. Obviously, nothing in trading is unanimous, but this is about as close as you can get. So we'll introduce you to this. This is going to sort of go over how individual stocks move, and this is going to tie into the context of market breadth and market pressure, and it'll sort of lap everything together there here at the end of this presentation. But so I'll start us off very simple. The Wykoff price cycle, in essence, is going to be split into phases. So phase one is going to be accumulation, where big investors and institutions and retail traders are looking to accumulate shares. And so what you're looking for is to build sort of a range in here, and you're going to be looking for price to consolidate in this range and stop trending down. And then what you would expect to follow this is a phase two, which is a mark up, and this is going to be the very steep uptrend that a stock makes, and this is where I am looking to trade. I'm looking to trade pullbacks and breakout setups within this phase two markup. And then at the top, you'll have a distribution phase, which is the opposite of accumulation. For distribution, once the stock has effectively made its big move, investors or people holding large positions are going to be looking to distribute those and really get shares off of their hand and sell their positions. And then what follows that would be a phase four or a markdown. And then you would enter into a phase one accumulation all over again, and the cycle would just repeat time and time again. So this is going to be the very basic and the most bare bones way to explain the Wykoff price cycle, but we'll get a little bit more nuanced into here. For the Wykoff price cycle, if you're looking at an actual chart, it's going to look a little bit more like this. When you're looking for accumulation, you're going to be looking to build this range where price has stopped trending down and we've entered into this sort of consolidation period. And this could be angled a little bit upward or a little bit downward, but you're looking to build these ranges and basically be able to draw a flat trend line across these ranges. And then we will start and enter into the phase two uptrend, and then the same thing will happen for distribution, and then we'll be in the phase four markdown. And if you had a question about what this little like pop under the range here is, this is something that Wykoff called a spring. So this is a failed move to the downside where many sell orders are triggered, and it means that there is not very much selling that is happening. People are not holding sell positions in this stock anymore because they've all been triggered. If you were a trader and you thought that you were going to catch a breakout in this area, and then you had your stop loss at the low of these. When we cross that low, a lot of these stop orders are going to get filled, and suddenly there's not a whole lot of selling going on in this stock. So a lot of supply has come to the market, and then with the if there is strong demand, investors will buy up the supply, and it'll start the phase 2 markup. And you can see this at the bottom here for phase 1 accumulation going into phase 2, and then you'll also see this for phase 3 distribution into the phase 4 markdown. So for distribution, it's going to be a little bit different. It's going to be just a failed move to the upside. Price is going to try and push higher, but people are unwilling to pay that high of a price. And then once we start to see flushing back down, you're sort of going to realize that people are unloading positions because they don't think that price is going to go any higher. And that's what's going to start this phase 4 mark down. And then it'll just start all over again. But so if you were going to look at this on an actual chart, this is going to be Carvana. The way that you would start to recognize this, and I'm going to try and train your pattern recognition a little bit, is I'm going to go through in snippets at a time, and I'll point out the very specific details. So if we were looking at this, and Carvana has just traded down very, very heavily, very sharply, and we've sort of come to this little base here at the bottom where it doesn't really look like price wants to go lower, but we aren't really sure. And then we're going to see, so this is going to be labeled as the selling climax, where it sort of feels like the price doesn't want to go any lower, and it feels like the price has really crescendoed down into this range, and it's just sort of going to hover there for a minute. And then what we're looking for is a change of character or a decent sized leg of buying. So if you can see throughout the downtrend in here for this towards the selling climax, we have just very minimal buying, and when we do have buying, it gets slammed back down very quickly, and then we buy a little bit and then it gets slammed back down very quickly. So when we see this larger leg up, it sort of provides us with a new frame of mind where the character of the stock has changed a little bit, and we're looking to maybe potentially build a base and then enter into a phase 2 uptrend. So we would see this uptrend here, and you would call this the change of character. And so from here, you could be looking to draw basing lines. So you could call and because these touched a very similar area, you could draw this as the top, and then this base down here would be at the bottom. And so then we're going to trade down just past that range, and we're going to take out all of these sell orders. So if anybody had sell orders down in here, suddenly they're all triggered, and that's what you're looking for in here. And this looks very similar to a spring in Wykoff's phase 1 of accumulation. This looks very similar, which is sort of the precursor for the uptrend that follows. And then so we'll trend up, and we're sort of back out of this range and back into this range, and you can see the strong buying. I don't have volume on this chart, but you could see that there is strong volume in here based on like the huge buying candlesticks. And then what's very common to see is that we'll break out of the range for just a second, and then we'll sort of retest the range. And if the retest goes through and we do not enter back into the range, then this is sort of where you're looking to buy if you were trying to buy from a Wykoff perspective, because this is sort of what is going to solidify this as a phase 2 uptrend that is sort of upcoming. And so this is what is going to be the retest, and then the rest of the trend will be as follows. And then up here at the top is going to be where you start that distribution phase. So we have started to have this big change of character. We haven't had a whole lot of selling, or the selling has been very minimal. And then we have a lot of selling, and we sort of test that range, and we're starting to spring here. And we would be looking to see a huge move to the downside again as a markdown occurs. And so I'll give you this other chart, and I'll give you a second. You can try and find where this Wykoff cycle is. I feel like it's pretty easy here, but just to give you a little bit of pattern recognition with nothing drawn on there for you. So I'll give you a couple seconds, but this is really where the pattern recognition comes into play here. So same thing, we've traded down very sharply, and we've had this big crescendo, huge selling candles into this range here, and we've sort of double bottomed off of this. We would call this the selling climax, and then suddenly we have sort of a steep buying, And so this is the change of character that we're looking for. We sell back down past this range and immediately follow it up with buying again. So this is a spring action, and then we trade out of this range, we retest it a little bit, and then we start the phase 2 uptrend. So in the same way that market breadth can be used to track and keep an idea of where indexes trade from in the general market health, the Wykoff price cycle can be useful to sort of see where stocks are in the process of their phases. You don't want to be looking to buy stocks that are about to seemingly start a distribution phase where then the only thing that's on the table is a downtrend afterward. You want to be looking to buy stocks as close to this move out of accumulation as you can, because this is where stocks are going to be the strongest and have the strongest upside potential. And then so to highlight what distribution looks like, we're going to be looking at RKLB. This is if we have some really strong buying in here and it sort of starts to fade out, and then this is where stuff starts to get really choppy. And so at the top of here, we've had virtually no selling for the trend up. And then we have huge selling in here. Price tries to go back up, huge selling. Price tries to go back up, slammed back down. And we get to this top of this range again, and we've sort of, once again, made this range in here. And this is what I was talking about, where the column or the range does not have to be perfectly flat. We could have a range that looks like this, where this is the buying climax. You have your change of character in here where we're trying to buy and nothing really was working. And then so we get slammed back down. We have a spring on the upside where price makes one final test to try and go higher. And once again, it gets slammed all the way back down. We retest it a little bit, and then we move down and further to the upside for a mark down. So this is what you don't want to see when you're starting to get into a stock. If you had a position that you bought into here and you see how we run into this price here and we get slammed back down, we run in again, get slammed back down, you should be looking to exit that basically as soon as possible. And so for the next section of this, I will say that the data here that I'm presenting comes exactly from Mastertradingflow on YouTube. He has a really great channel where he analyzes some breakout setups and specifically some Qualimaggy type setups, and I found some of his statistics to be really interesting, and so I'd like to present them for you here. But this is his channel. I'll link him in the description. His videos are great. I think that anybody could take the time and watch them, and I think that you would find something valuable from them. But this video in particular, the breakout setup failure rate, is what the pictures that I'm going to provide come from. And so for this video that he has on YouTube, he analyzed almost 2,600 stocks, and these are the metrics of the stocks that he traded or that were in the database for the almost 2,600 stocks. And so this is the timeline, and this is credit down here. And then, so the findings that he found were that the vast majority of breakouts occurred when SPY was in an uptrend, and this is just sort of reaffirming this whole idea that trading conditions are going to be incredibly important and a really big deal in terms of finding the optimal times to be in the market and when to sit out of the market. So for breakouts, just about 62% of the time, SPY was in a uptrend, and then for 30%, SPY was in a sideways trend, and only 8.3% of breakouts occurred when SPY was in a downtrend. And then the exact opposite is true for breakdowns or failed breakouts. And then the other thing from this video that I found very interesting was the graph on here for his breakout and breakdowns map, which I found very interesting. So each of these arrows up are going to be a breakout to the upside, and arrows down are breakdown to the downside. And then he has them colored by the sector and industry. But so what you can see is that breakouts and breakdowns happen in these clusters. So when SPY trades very sideways, there's not a whole lot of action that you can see. So when we trade sideways, you're going to have a lot more breakdowns and not very many breakouts, but there's still not a whole lot of activity. But then when we get these sharp uptrends, you get a lot of breakouts and not a lot of breakdowns. So being in the market at the right time and in the right stocks is sort of the name of the game here. And you really need to focus on when the right time is, because you need the market to be favorable in your condition. So I'll wrap this up and just sort of give my final thoughts on this and just how they work together. But market breadth gives us insight into what the direction of the next swing for the market may be, and it can be used to gauge the aggressiveness in which you trade, and it helps you adapt to varying trade conditions as the market sort of ebbs and flows throughout this market tide. And then market breadth contextualizes the whole market as a main movement, and it just sort of moves in this cyclical motion, and you need to be aware of that. And then the Wykoff price cycle really helps us. It can be used as a setup in and of itself, but the price cycle applies to any asset with free supply and demand. And learning to recognize what stage a stock might be in can be really helpful for referencing, and it can be helped to identify the strength, duration, and likelihood of a future move. So it can be helpful to know if we are at the what seems like the very top of a phase two markup, and you would be looking to feel like you missed a move and you wouldn't be looking to buy, or if we have just come out of an accumulation and it's worth it to get into the stock on a pullback because there's still room left in the tank. And then for as far as the trading or the master flow trading info, the presence of good market conditions is going to be really key to improving the odds of a trade in your favor. So the amalgamation of this info, I touched on a couple things throughout this, but they all are basically going to fit into the same box here. So understanding market breadth, price cycles, group action, and the importance of favorable conditions is going to be very crucial for knowing when to be in the market and when to sit on the sidelines for it. And without a foundational understanding of when the market is favorable for your trading, trading becomes no more predictable than gambling in a sense, because you don't know the context for which you're operating in, and you need to be very deliberate in where you put your money and how like the timing of that. Because if you could be in the best stock you could be in the best stock of all time, but if the market is slamming that stock down and it has so much weight on it and it's in a bad group, or we're in a bad market cycle and it's in a bad price cycle, it's going to go nowhere and you're going to lose money. But you could be in a mediocre stock, and if the context of the market is incredibly strong and the group is incredibly strong, there's going to be a lot of pressure upholding that stock and a lot of fire lit under that, and you're going to have a lot more success trading from a top down approach. And that's why this entire series so far has started from as zoomed out as we can, and it's going to get more and more narrow as we go. So it's going to get a little bit more complex as we go, but this is sort of where this is going to wrap up. But these are going to be very important things to pay attention to as a general context. You need to be aware of this stuff, and you need to watch this video a couple times. And there are a couple Jack Corsellis videos that I'll link for this in the description, but I think that this is sort of what is applicable and what you need to be very, very aware of, and just at least on a surface level for trading. But so maybe watch the video a couple times. But as far as this goes, this is about where I'm going to wrap this up. For the next video, we're talking about software layouts and charting, and this is going to get even more into the thick of details, and this is where the series is sort of going to start to take a turn into actual trading info and sort of how you trade and what you are going to use to trade. We're going to get into the actual action taking of that versus what everything in the series has been up to so far, where it is just general info about the market and sort of giving you the knowledge of what the market is that is sort of hard to come by. So I hope that you enjoyed this video. I hope that it was valuable, and I hope that you could learn something from it. But I do think that it's something that is going to go over most people's heads until you really take the time to sit and digest the knowledge. So I think that that's really important if you are okay to take the time to do that. But anyways, thank you for watching. Stay tuned for the next one.